tryna take it down, place for you just scoring minds, best the bar.
All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, we're going to talk about the long-term portfolio. So I started a brand new investment portfolio literally at market highs. We created this account, as you'll see, since 10/8/2019. That is when we created this account. So there's two accounts. We did a small one, which has $1,300 in it, and then we have another one with about $6,187. Right now, it is sitting at $7,491. But you come here, here's on the Thinkorswim platform. It says we're up total 207.47 or 2.8%. So what I want to highlight here is pretty much what happened. You know, what happened when we bought in at pretty much all-time highs, October, you know, at the time we started on the 8th. So like right here, it was kind of coming down by the time we fully invested and made all the trades every single month after month. And that's been the plan with these portfolios. We're adding every single month and we're putting it towards stocks that we want to hold for long term, both dividend and growth stocks. But literally, since we made that account, all the market did was make brand new highs. So I want to show pretty much what it has been like and what has been the performance of buying at all-time highs, and then even what's happening now that we're getting kind of a reversal here. And now some people, this is letting people to believe, well, what do I do with long-term? Should I not invest now? Or this is why I wanted to wait. And now also for you guys holding a long-term account, what do we do in the midst of this and how do we move forward? So I'm going to go over some of my future plans with this account, highlight what we did, go over the stocks we have in here, and then also just some of the key points to take away from all this. It's pretty interesting to see. Again, you know, before we went down, we were up at like 7,800. Then it started coming down. Again, you'll see the positions here, but it's going to be interesting. I have some keys for you. I have really quick summary points to go over. So let us get right into it. But before we do that, make sure you guys drop your thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open. It's the first link in the description and it is pinned in the comments. So we have videos on the long term, but we also live stream every single trade on this. So we've done every single one of these trades live. We built it. We made this account. And again, I'm doing two different accounts with two different amounts. So, you know, to try to appeal and show really what you could do with long-term investing and with, you know, different scales. So I encourage you all, you know, paper trade with options, get a long-term account. Don't be out here, you know, day trade for a living, go trade options, do whatever you want. You know, always try, baby, and persist. But make sure you get a long-term account. It's never going to hurt you to keep money here. Again, this is why I even call it my mom's long-term account, because I did this to even show my mom just, you know, how much more stable it could be. This is just pretty much a glorified savings account. You know, we diversify with different assets to expose you to a little bit better of returns, but more safety. But yeah, watch us do it live. Hopefully we see you there. But yes, let's get into it. So before we get into the positions, you know, really what I want to highlight, I will show you here, but it's summarizing is this. In, you know, from buying at all-time highs, what we did, we have a total of 9 different stocks in different sectors. So we have, I think, about all like 5 or 6 dividend stocks and then 3 growth stocks. So we're more weighted towards dividend stocks now. However, that is just this simple amount of stocks. But the next key you're going to notice from this, you know, what affected your performance, whether it's through this downturn we're seeing now, or even if you did buy at highs, what would be your risk or how things would play out? It's relative to the position size. So we did pretty good for the most part, but when some big losses here and even some of the biggest gains, you know, with like Snapchat, it has to do with the position size. So you could be diversified, you could have 9 different positions, but if 90% of your balance is in one stock, that's not really going to do anything for you. So you have to understand how that would have an impact. And we did get to see that here. And this will coincide with, you know, exactly the plan we're doing for this long term. But another thing that you will notice, and I think shout out Mike Tyson, baby, he said this. He said, you know, even though stocks come down, you get to keep the dividend. And out of these 5 out of the 9 stocks that were down, every single stock that is down overall, you know, net gain means it is not only just down for the day, but down from the first day we bought it. Every single one of those stock pays a dividend, and we've already received those. We have those on dividend reinvestment. That's why you can see like Walgreens, Altria, and IRM, you see fractional shares there because we've got the dividend and we reinvested it into the stock. So even though the stock price could go down, the value, they can't take the dividend away from you. And that is the point of this long-term account. We want to hold these stocks over, you know, a 10-year period. So, you know, even month by month, year by year, it's interesting to see this, you know, in the results. But at the end of the day, all we're looking to do is acquire equity. So that's why price, you know, what that you buy it at is all relative to, you know, the sizes that you buy, but what you do over time. But every single stock pays a dividend, and that will lower our cost basis. And we'll see now, since it's very early on in this career of this portfolio. The dividends aren't going to help lower our cost basis too much, but that still is something to keep in mind. But the main thing we're going to be seeing through all of this, and again, the summary of this portfolio, it's showing, even though we are down on some stocks, the fact that we diversified, took different sets, and again, different position sizes. But the key that Warren Buffett says, the key we're trying to highlight with all this is that stocks get less riskier the longer you own them. So even if you did buy at all-time highs at the end of last year, it's been about 4 months, very shortly it'll be 6 months, very soon it'll be a year, but as they've appreciated, even though you come down, you still have a decent sort of gain. So far, what we even saw from the all-time highs, this is about a 3% move down. So that's pretty big for the broader market. But even if the market drops another 3%, you see we're up about 2.88, about 3% on both combined accounts. On the smaller account, we're up 3.69. The one with bigger positions on the mom's long-term, we're up 2.7, but we're still up about 3% since we've bought everything, and we've bought those all over the course of all-time highs. But at the end of the day, even if the market drops another 3% and is down 6% total, then we would just be at break even. So we necessarily wouldn't be losing money. We would just be at break even, but then we've also collected dividends, and at one point we did have an opportunity with profits. But now, even if it drops 6%, dropping the market 9% total on the year, we would only be down 3%. So your losses are always, relative to when you purchase and how long you own them. That's why I'm saying the longer you own them, as stocks move and they appreciate, it protects you a little more, because at the end of the day now, if you bought at the beginning of the year, in the beginning of 2019, when the year started from like 248 till now, and then even having this drop, you would still be up 29%. But moving forward, I'll show you guys the positions, and this will make some more sense here. But as the market drops now, I'm going to be patient and utilize time. That's how we're going to be moving forward with this account. If you don't know, I'm depositing $2,000 a month. So by tomorrow, we will have $9,500 or $9,700. I do $2,000 a month into this account and then $200 into this one. But that has been the key with these accounts. It's that we're adding money every month. Again, we're treating this like a savings, just saving money. So as the market comes down in prices here, or if it does continue to drop with everything going on, I'm going to utilize time, and I'm going to make, even one thing to even keep focus on. You don't have to really buy month after month, but use the clock and analyze stocks in periods, especially when you're adding to the long term. You don't have to just deposit money and deploy it right away. So if we start coming down a little bit more, I'm going to be patient. I'm going to focus on the companies that I want, but it's when do you really need to make a decision? I want to make purchases and make the bigger purchases around dividend dates and ex-dividends, and then either before or after companies report, because that will give us guidance into the company and the values will change. So, you could have time, you could keep depositing, and really the key to all of this is understand purchasing power of your dollar. So you could deposit money, whether you decide to put money in the markets now or you did months ago or a few years ago. As the markets move around, sometimes, as stock prices come down, this is going to be the strategy when we're looking at stocks to buy. Now that AbiVi's lower 8%, our dollar is giving us 8% more purchasing power. If Snapchat's up, then it makes more sense for us to buy more AbiVi than getting less for our dollar with Snapchat. So now as the market moves a lot bigger, and you're now able to get real big, discounts on stocks, or now it's making a difference, extra 5-10%, you could utilize that great with time. So these are the keys from it. And now the last part, this is what you see what happened. This is AbiVi. These are all the stocks that we own between both of them. And here's what I was saying, here are the stocks that are down. AbiVi's down $200 net. We're up on Beyond Meat. We only got one share of those. This is for Disney. And again, these are on the smaller accounts. So pay attention to the position sizes, only worth $110 for one share. One share Disney, $138, but we're down $6 total. IRM, the REIT, again, we only have $96 worth. We're down to $1.88. Altria, only $96. We're up $9, still up 10%. Snapchat, we're up $450. We had that in both accounts, and on both accounts, we are still actually up on it from the time we purchased. We're up on Spotify. That's in the smaller one, and then AT&T, we have that in both accounts, but we're down 3% on the bigger position and only 3 cents. And then Walgreens is on the small account. We're down there, but again, through all of these positions that we own, AbiVi is both dividend and growth, but this pays a dividend. Disney is dividend and growth as well, but they pay a dividend. IRM is mainly just the dividend, so they pay a dividend. AT&T is both mainly dividend, but has some growth. Same thing, Walgreens is mainly dividend with some growth as well, but all the dividend stocks are down, and the stuff that is actually up, and we're still up a decent amount. Spotify, we're up 4%. Snapchat, we're up 12 to 32%. Altria, which is a dividend stock, again, and we bought that really at the bottom. I remember we bought it around these prices, October 7th, 8th, when we made the portfolio, so we're still up even as they're dropping a little bit more. But now any stock that is offering a discount, they're offering a dividend. So that's one thing. And then you're also seeing how now at times, different types of industries, different types of stocks have made this portfolio, has given us an effect. Realistically, we just bought, you could see the total amounts. Our biggest positions are in Snapchat. We have 3,500 there. And then to balance that big position, we got Abivi because it is both dividend and growth, but we're down $200 alone. So if we didn't make that Abivi trade overall, we would be up a lot. But again, we could start buying more Abivi at a cheaper price, and we'll see, analyze this in 3 months to a year. But you're seeing now the effect of how when you are balanced more in one position or a few positions, those are going to have the biggest impact on everything. But that's why even if we go to the YouTube long-term one, most of these positions are balanced out. We still have, $240. It's the largest position here, or second largest next to Spotify. But you see how things are balanced out here. But overall, as far as growth stocks, if you bought these at all-time highs, when we started this portfolio, it's hard to get your hands on these without paying some sort of premium. But now if you started investing, you're getting if you started investing now at all-time highs, growth would cost you more money, but dividends and some of the safer stocks would actually be cheaper. So that has been the performance, but overall, we're up still 3%. We have a little bit of a cushion, not as much, but as you see here over time, the key is going to be moving forward, and I encourage you guys to watch what we do with this and how we go forward, because then you're going to see how this will balance out over time. And yeah, but that's pretty much it. I mean, if I could say anything to summarize this and end it with is, stocks become less risky the longer you own them. It doesn't matter when you start, as long as you start and you have a plan, and, we're consciously looking at this. We'll see, how February plays out. Even if it goes down, we don't have to make purchases right away, but we will see, if there is opportunities to buy stuff. And another thing I would say too is make sure, you have the fortitude to hold on. That's why you want to diversify, so that when things do drop, you don't want to have too big of positions, so that you don't get too hit by one bad stock. Diversifying in big names and stuff, that is very important. And even moving forward, I'm going to look at like Abivi. I'm going to buy more of those. Here are some of the main stocks that we have in the portfolio: IRM, Altria, AT&T. Those are kind of the ones I really want to pick up on. And, over the next few months as these stocks drop, we're going to let the growth work, and I'm going to look to pick up those dividend stocks at some discounts here. But do not be afraid. And again, like Warren Buffett says, invest as if you can't change your mind for 10 years, when you make a decision. So, if you don't put any, again, control the position size, but don't take positions. You could let your money sit and try to, let you get more purchasing power. You don't want to sit too long, but you don't want to get too active. And the real main point of this is you just don't want to constantly be moving or reacting to the market too much where you're selling out of a long position. So if you don't see yourself as liking the price, or if you're not okay if you put $1,000 and drop 10%, you lose 100, kind of get familiar with what could potentially happen, because the key is to stay in it and acquire equity over time. That will eventually, again, with dividends and all that, it will lower your cost basis. So let time be the judge. But in the midst of all this, kind of start planning for the future with whatever happens with the market. But an option you should never have is to sell out, especially if you just acquired a position. What you could always do instead of selling out, you could stop adding to it. You could acquire more of a different share in the portfolio and balance it out with other companies. But try to keep your money in and, actually invest. You're not there to just reevaluate a performance after 3 months. Give it some time. But I'm going to leave it there. Hopefully we see you guys tomorrow on the watch list and the live stream. But let's go!